welcome to the FII View. I'm Tanveer Gill. My guest today on the show is Ewen who's the Chief Investment Strategist at the BlackRock Investment Institute. Ewen, thanks very much for taking out the time and speaking with us. But my first question to you, Ewen, is what did you make of the Fed's recent comments? What's your interpretation of what may happen over the next 6 months?
Very unsurprising in the generality, a bit more specific in terms of the timetable about reducing tapering. This has been well leaked in advance, starting with newspaper articles about 6 weeks ago, then Chairman Bernanke's testimony on the 22nd of May to the Joint Economic Committee of Congress, and the press conference really just put some more details around it. It's still going to be data dependent, it's still going to be labour market data dependent, but now we have a very clear timetable about their intents.
What is your expectation in the September policy then? What do you think the Fed will do?
Well, I'm going to echo the chairman when he was asked that question at the JEC on May the 22nd. He simply said, I don't know, when asked about the exact timing. But they've made it clear they'll start before the end of the year, data dependent. So, it has to be September, November or December just because of the calendar. As to how much, I think that that's reasonably clear. It's going to be a bit at a time. So I don't know, maybe 20 billion first off, and then another 20, and then going towards zero by the middle of next year. But again, it will depend on labour market conditions.
That brings me to my next question, which is your view on the dollar. For in India, there's still a lot of concern about what's going to happen with the rupee.
Well, of course, currencies, there's both sides of that, isn't there? The rupee is falling, and of course it's been particularly dramatic in the last 2 or 3 weeks. But the dollar was rising against most currencies. Then in the last couple of weeks it gave back a little bit of ground, and now it's started to strengthen again. I think it's fair to say that taking the dollar in isolation, all of the fundamentals suggest in the medium to longer term it's going to be a strong currency, having been a weak currency for the last 10 or 15 years, and that's both to do with the shape of Federal Reserve policy, with the strength of the US economy, and also crucially with the whole shale oil business, which means the US imports less energy, and so its current account deficit declines. Now, as far as India is concerned, I mean, India, I think, has been caught in the cross triggers of the general outflow from emerging markets, and that is much more acutely felt in countries that run, current account deficits and fiscal deficits, as India does. And you can see that the market, the South African rand, for example, has also been particularly badly affected, and now the Turkish lira. So, whilst I can understand sensitivity inside India, the only thing I can say is India is not alone in this respect.
Give us your sense. What do you think a QE withdrawal would do for EM equities as well as EM bonds?
Well, a stronger dollar clearly doesn't help. I mean, the relationship has been clear that the dollar has been strengthening slowly for the last couple of years, and during that period emerging market equities have underperformed developed market equities by nearly 30%, which is a big amount in the long-term history of developed markets relative to emerging markets. For emerging market bonds, it's only very recently that they've started to come a little bit under pressure, because up till about a month ago they were really benefiting from people's search for yield and diversification of yield sources, and that's become quite a crowded trade, and so therefore the reversal that we've seen. But to be clear, a consistently strengthening dollar for countries that import capital, because the dollar is the price of world capital, if you know what I mean, is not helpful to their financial markets, because of course the countries in question have got two choices. They let their currency weaken, in which case money flows out, or an inflation risk goes up, or they intervene to strengthen their currency, and in intervening they're taking money out of the local system and tightening liquidity, which doesn't help financial conditions. So just as when the currency is strengthening, capital coming in, all is good, or for a while all is good, when it's going out, I'm afraid it's a bad time.
Give me your sense of what is your expectation on risk over the next 6 months?
I think the risk, as measured by volatility fluctuation, is clearly going to be higher over the next 6 months than it was over the last 6 months. But I really think that it's important to say that this tightening in global liquidity, which I'm talking about, could either be very slow, led by the Fed, or it could be a bit faster. And if it's a bit faster, it's because of the outflows from emerging markets, the drawdowns on their reserves, and the reduction in liquidity that that creates. But, let's be clear, of course, one of the reasons that the Federal Reserve is contemplating this is the American economy is recovering, and they believe it's going to recover at a faster pace as the drag of fiscal drag reduces in the second half of this year. So, and commodity prices have fallen as well. So, on the whole, this isn't bad for the world economy and for world inflation outlook.
Also, with bonds not looking attractive and the expectation that there could be a fall in equities if a withdrawal is announced in quantitative easing, where do you think money will find its way? Gold, base metals, the dollar?
Not into gold, no. I think that, although, the fall in the price of gold has already been very significant, trading now today at just under $1,300 and having had a high a few months ago of $1,700. But I think that there's still, if the dollar strengthens and monetary conditions tighten gradually, as I say, I don't think there's an enormous attraction in gold until it reaches the price where physical demand, end-user demand rather than investor demand is driving the price. Now that's somewhere between $1,000 and $1,200 an ounce, judging by past behaviour. So I don't feel inclined to get involved in owning gold still, but it's beginning to come towards a price where it becomes more interesting. For base commodities, I think again the dollar doesn't help, but the base commodities are nearer to the marginal cost of production. And the marginal cost of production always matters, because at that level, miners, producers, oil producers start to cut back on output. And that has an impact on supply ultimately. For now, commodities are out of favour, they'll probably remain out of favour, but as the price falls, because it helps growth globally, it helps Indian inflation as well if the energy price falls. But I think that we're not quite at the point to commit to seeing commodities as a good investment quite yet.
What do you expect in terms of Germany's influence on the Eurozone, depending on the outcome of the impending elections? How do you see that story panning out?
Absolutely, and I think the outcome of the elections is less about whether or not Mrs. Merkel wins. I mean, she is the dominant political personality in Germany, but more how the negotiations go in the formation of a coalition after the election. But all of the three main parties in Europe are in Germany, are all pointing roughly in the same direction. And that's one where, they believe, and I think this is correct, that structural reform has to be the answer for Europe. And that structural reform has to be something that brings down labour costs, deals with labour rigidities, goes through the pain that Germany itself went through half a dozen years or so ago. So I don't believe that if people believe that after the German election, Germany's suddenly going to become all soft and cuddly in relation to the rest of Europe, I think they're going to be disappointed in that view.
Then the next important question is what happens to peripheral Europe or the Eurozone as a result of the developments in the US? Will they also follow what the central bank in the US is trying to do, or will the mindset really be still, we will do whatever it takes to keep the economy together?
I think that Mario Draghi would love to have the problems that Ben Bernanke has, because it would mean that the rate of credit growth and the prices of underlying assets in Europe and therefore the health of the financial system was beginning to improve, but we're nowhere near that. We're still actually in a place where the European Central Bank balance sheet is declining in size because solvent banks in Europe are paying back capital that they borrowed in the LTRO program to the European Central Bank, and there's no demand for that capital being repaid in terms of new loans. So I think that Europe's a long way off a condition where it tightens because the economy is good. Where the European Central Bank now is that actually policy is tightening because banks are repaying capital rapidly rather than rates are rising. And that's a very different type of tightening. It's one that keeps economic activity very constrained rather than there being any risk of it running away with itself.
Where does that leave your view on the euro then?
Well, the euro should remain a strongish currency. That might sound odd given all the crisis in Europe and so on, but you need to start off by thinking it like this. Europe runs a current account surplus. What that means is that Europe doesn't need to borrow any money from abroad to finance its own savings and investment from outside the eurozone. So it's a self-contained money zone in that respect. The euro only really materially weakens if Europeans lose confidence in the euro as an item of exchange. And we saw a bit of that in 2011 and the beginning of 2012, which was why the Swiss National Bank had to peg the Swiss franc to stop it becoming too expensive and ruining Switzerland's domestic economy. But I think that outflow has come to an end, and people are more confident that the euro is going to remain in position for a fairly lengthy period of time. Now, that could change. It could change if there's a domestic banking crisis. It could change if particularly conditions in France, which have been deteriorating slowly, get a whole lot worse in terms of output and in terms of France's competitiveness. But these are things that will take a while to come about. Meantime, Southern Europe, peripheral Europe, Spain is now running a trade positive balance. Greece is running a trade positive balance. Ireland's running a trade positive balance on a current account balance. Portugal's very close to it or at that level. So the bleeding of money out of those southern European countries relating to the financing of activity has come to an end, and that's helping the euro overall.
Also, want to get your perspective on the yen, which has been very volatile after going past 100. It's getting pretty much range bound. What is the expectation of where it goes from here?
Well, the interesting thing about the yen is that the fall from 75 to 103, and now it's back at 97 or whatever, that fall from 75 to 103 was not the result of Japanese citizens selling yen. And we know this because you can look at Japan's balance of payments over the last several months, and they're about even. So it hasn't been domestic Japanese selling the yen. Then when you look at the trade in yen on the Chicago Futures Exchange, and you can see that there's been a massive short selling of yen going on there. So all of the selling of the yen has been by offshore agents. Japanese banks, who had been the one major banking system in the world, who'd been expanding their foreign assets, have begun actually to repatriate assets back to Japan because of what they see as better lending conditions there. So that's added up because 95% of the stock of yen is held by Japanese citizens. That's ended up that because Japanese citizens haven't lost confidence in the yen, whilst the Bank of Japan is increasing the money base very materially, that money isn't leaving Japan quite yet. It will do over time a bit because Japanese institutions have said that they want to expand their overseas investment a little bit, but it's going to be a very slow process. So those calling for a yen at 110, 120 might find that it takes a while to get to that level. At this sort of price, it's it's still slightly overvalued on a long-term basis, but probably reasonably close to the level justified by the balance of payments.
What's the view on India as a market? Do you think the market can move higher from here?
If we get any stability for a while in a world where commodity prices are declining, and that helps the domestic inflation and therefore helps the RBI with their interest rate policy, then I think Indian equities are interesting. First of all, the second thing I would say is that next year's presidential election will be closely followed by foreign investors, and it rather depends who emerges to lead the BJP. If it's Mr. Modi, it seems impossible at this stage, then I think that the stock market will rise because the expectation would be there'll be a pickup in the reform program if he were to be elected, and Congress will have to respond through at least making promises. Whether or not they carry through those promises is another matter. And that's good for the Indian, and that's the sort of thing that foreign investors particularly think about when they look at the Indian stock market. And the other thing I would say is that one of the things that does concern me about the Indian stock market is why the large companies in India continue to actually find opportunities outside India more attractive than inside India. And the sense that those large companies are saying, we don't like investing in India, we'll invest abroad, it doesn't necessarily increase your confidence as a foreign investor in putting money into the stuff that they're selling.
Ewen, how are you looking at the political risk in India at this point?
It's the currency risk. I mean, again, repeating this, it's the currency risk because it's impossible for a foreign investor to hedge rupee exposure. So, if the currency goes down by 15% and the stock market goes up by 5%, you've still lost 10% in your own currency. So it really is down to the currency. I think the inflation risk is a bit lower than it was. Of course, the collapse in the currency, whilst I said, lower inflation, lower commodity prices help, that's a bit offsetting that trend because, of course, the imported price is rising a bit now. So I think it's an inflation issue. I think whether or not that does remain at this kind of low level, whether the currency stabilizes, and then it comes to the politics.
Do you think that there is a scope for more easing in India in terms of more room for rate cuts?
Well, with the WPI at 5% and the policy rate now real 2 to 3%, that must be the case. But of course, the RBI is reluctant to do that whilst it sees the currency collapsing because that doesn't help compensate people for holding assets inside India. So it's a bit of a standoff at the moment.
Okay, let's drill it down to the key macro indicators for India. One is the direction of the rupee. So what's your view there? On growth revival, what's your expectation? And inflation as well, what is it that you're foreseeing over the next 8 to 12 months?
The view on the Indian rupee, and I'm going to confess that I'm going to give a very general view, is that it has fallen quite dramatically. That is to do with the current account deficit and the fiscal deficit in a point in time where liquidity is generally flowing out of emerging markets assets. So it gets multiplied up if you have a funding gap. And if that funding gap comes in a bit, and if the confidence in emerging markets stabilizes, then the Indian rupee is oversold and will rise. We've seen this movie before a few times, but remember, if the Reserve Bank of India intervenes to smooth the currency, it's doing that, it's taking money out of the domestic system. So it's a tightening in domestic financial conditions. But, we have seen this movie on the rupee a few times before, and it's driven by Indian factors and by non-Indian factors.
To your mind, Ewen, which are the top 3 macro concerns for India right now, and how, in your opinion, do they need to be addressed? 3
main macro concerns for India. Will the pace of reform, as opposed to the promise of reform, ever pick up? That's number 1, because ultimately, India's not growing as it should do, and clearly there are restrictions on that growth for good and understandable domestic social reasons. Second concern is the volatility of the currency, because it isn't just the level of the currency, but as a foreign investor, where I can't hedge that currency risk, something that could go from 50 to 60 in a very quick period of time concerns me a lot as a foreign investor, because it affects the value of my clients' portfolios in that respect. And the third is obviously, why are Indian companies still exporting capital from India? That's more of a micro than a macro question, but that would be my third concern.
Well, Ewen, Fitch recently said that they, are revising India's macro outlook to stable now. Do you think India has managed its issues better given the circumstances vis-a-vis other emerging markets?
Well, I find this a very difficult question to answer, and the reason for this being that one could say yes, judging by Fitch's judgment, although on our own quantitative measures of India's debt position, it doesn't look any better than it was 6 months or a year ago. But of course one has to say no, as judged by the currency movement. I mean, the currency movement at the end of the day is the market's confidence in the Reserve Bank and in the government. And I think that the voting is very much that whilst the outlook may be stable, it's not terribly great.
And finally, I just wanted to ask you about the big story that's playing out in China. Are you worried about the China situation?
China's definitely going to be slowing down in its growth rate every year for the next 5, 7, 8 years. And that's because, first of all, the population isn't growing to the same extent as it was historically. Secondly, the new government very clearly wants to stamp down on speculation and on excess credit growth, and in an economy led by fixed asset investment like China, that matters a lot, because if credit's less easily available, fixed asset investment doesn't grow so fast, and the economy as a whole doesn't grow so fast. But it might be better balanced growth. So I think it's important to say, look, China at the moment has a domestic credit problem, that it's allowed credit to expand too fast, and economic growth isn't accelerating to service that credit, and we're seeing a lot of volatility now inside China because of that. China mostly owes its debt to itself, so this will be something that will be dealt with through an increased fiscal deficit. But ultimately, you have to believe that China's growth rate over the next 5, 6, 7 years will decelerate to, maybe around 4 to 5% per annum by the end of the decade.
Well, that's it on this edition of the FII View. We'll catch you with another special guest next week. For now, here are some more important opinions and voices coming out on the concerns over China.
China's already facing a liquidity crunch in the banking sector. I think the most interesting thing is a central bank in any country can always ease the liquidity crunch through open market operations. In China's case, they could cut the reserve requirement ratio substantially. It's 20%. The interesting thing is the People's Bank of China has stood by. They haven't done that. And so we take that as an intentional policy sign that they are really serious about wanting to deal with the financial systemic risks, and that this is an intentional policy of keeping liquidity pretty tight right now.
The China banking problems are nothing like the scale of the Lehman crisis. Of course, the Lehman crisis affected pretty much every major financial market. You led to a freezing of transactions for 3 to 6 months. China, of course, has a closed capital account. That means it's not really integrated into the global financial system. So it's an issue domestically for China, but I don't really think it matters directly for other financial markets.
Markets are clearly taking fright at the kind of policy measures that tightens of liquidity and some of the disappointing economic data. But on the other side, you do have policymakers who appear quite comfortable with the relative tightness in liquidity, and they're quite clearly been trying to signal over the past year or so that they'd like to shift the economy away from its traditional export-oriented credit-fueled model to more balanced one that's driven by domestic consumption. Markets are arguably adjusting to that. So yes, this weakness could have a little further to run, but at some point, that may start looking much more attractive.